lenders are highly rational. And the reason these things are structured, the reason you have all these covenants, the reason they're doing so much analysis is because their incentives are skewed, right? There's much more downside than there is upside in a loan because you still can lose everything, right? Like there's a chance if the company goes bankrupt, the assets go to zero, you've lost everything and you have no ability to make it up on the other side.
Hi, everyone, and welcome to Climate Tech 360, where we connect with diverse voices in the climate sector to make informed choices in supporting the future of climate technologies. I'm your host, Samia, and today I'm speaking with Ziv Krieger. Ziv is one of the partners at Third Sphere, formerly known as Urban Us, which has been around for about 10 years in the climate tech investing space, so longer than most funds in this sector. They have a traditional venture fund where they make pre-seed and seed investments, but they also have a debt division, which formed about 4 years ago, and Ziv joined to help lead that effort. So he is a managing partner at Third Sphere Credit. Ziv has a really interesting background. Prior to Third Sphere, he ran alternative investments for Will and Jada Pinkett-Smith's family office, where he helped launch a dedicated consumer venture fund, ran direct private credit, and helped structure and form the family holding company, among many other things. He's worked in the investment management division at Goldman Sachs. And prior to that, he founded Brooklyn Atlantic Real Estate, a commercial real estate firm focused on adaptive reuse of former industrial zones. He also ran a nonprofit called Gowanus Canal Community Development Corporation, which is focused on sustainability, land use innovation, and community building. Ziv was a Benjamin Franklin Scholar at the University of Pennsylvania and has an MBA from NYU Stern. Today's discussion is part of a series on how to finance hard tech companies. And anecdotally, it's probably the topic that comes up the most these days as it relates to climate tech investing. Software climate tech companies fit well into the existing model of venture capital, but hardware companies or companies that combine hardware and software will likely need to access alternative forms of capital. And in this episode, we get into why. I've split up this particular conversation to two parts because one, we had a lot of content to cover, and two, the topic itself is quite complex if you're not familiar with debt. So in this episode, we cover the basics. What are the different flavors of debt that might be available to climate tech startups, and specific examples from the Third Sphere portfolio of companies who have actually raised debt. Importantly, we talk about the perspective of the lender because it's very different from the perspective of an equity investor. Lenders need to see steady cash flow so they can be assured that companies will be able to make interest payments and make principal repayments to pay back the debt. And most lenders will also look for assets or collateral. So we get into this in detail in this episode, and hopefully it'll be useful to you if you're a climate tech founder, but also if you're an investor. Now on to the episode. The thing on everyone's mind, at least from an investor and from a founders working in hardware perspective, is how do we finance climate hardware companies? Every conference that I have attended in the last 3 or 4 months, that was like the topic of discussion. And at New York Climate Week, Third Sphere was very much at the center of this conversation.
Thanks so much for having me. And my confession is this is actually my inaugural podcast.
That's good. Don't do any more until I release these episodes, please.
Yes. This is either going to go really, really well because I'll have hype and lots of enthusiasm, or it's going to go terribly. But
why would it go terribly?
It's your podcast. So you're going to live with the results ultimately.
I think it's going to be magic. I think that you have so much useful information to share, and there aren't a lot of people in venture that have a background in debt.
Let's jump in. I'm going to not let it go to my head. My newfound podcast stardom. I'm going to try to keep my ego way in check here. But thank you for the kind intro. And, it was funny. I feel like we've been sort of screaming into the wilderness for a couple of years about debt and the need for a thoughtful approach to cap structure. And in 2021, 2022, just no one could be bothered. There was so much dirt cheap, mispriced equity. And frankly, I had many conversations where people are like, well, I get that you want to lend to us in some actually properly risk-adjusted rate. They're like, but I have an investor offering me equity at I'm a pre-seed company. They're offering me money at $100 million valuation. I said, you should take it. You should scream. You should take that money and run naked screaming down the street because it's nonsensical. And that is cheaper than any debt you'll ever take. But that's not a normal market structure, right? And we're seeing the sort of the fallout from that. Point is, we've been screaming in the wilderness for a long time, working on this, saying, how do we actually do this in a way and encourage the industry to do it in a way that's actually thoughtful and aligned with the needs of these companies, the needs of early stage, growth stage, climate technology companies that might actually persist and that isn't just some weird artifact of incredibly cheap equity, breathless enthusiasm, the entire capital markets cycled into ESG. Right, to the tune of 30, 40 trillion dollars. And a lot of that money is cycling back out, both because of misrepresentation, right? People were sort of jamming all kinds of stuff into public markets ESG funds that didn't actually meet the criteria. And so there are all kinds of market normalization things that are happening right now. But it was really nice to sort of, for a long time, having people not really focused on this. Suddenly, it is topic number one because everyone's realizing venture equity is not going to do it on its own.
No. Yeah.
And it may only capture a tiny piece of what's required for the climate transition, which is some number, $6 trillion a year. Pick your OECD or McKinsey report, but $6 trillion a year of infrastructure has to be rebuilt.
Great. So I think that's like a perfect transition for us, because what I would love for people, mostly founders, to get out of this conversation is to try and figure out if there is a playbook for climate hardware companies. And you and I both have a background in debt, but a lot of people who are listening to this don't know what debt is. Let's just start with, what is debt?
Yes. Debt is an investment that at some point you have to pay back. And the other thing that's important to remember when you're thinking about debt versus equity is debt makes a trade-off between how much return you can possibly make and the security of your investment, right? And the predictability of you getting paid back, right? So like an extreme example, the higher the chance that you're going to get paid back. Like you make a really low leverage loan to a super giant company or the federal government, you have an almost certain chance of getting paid back. They're saying, well, the risk you're taking is really quite low. We are going to pay you very little money for that risk. And there's plenty of folks who it's more important for them to have consistent cash flows or whatever it is than to earn a high return. And so there's always this spectrum. And debt is at one end of the spectrum. And there's many gradations and flavors of debt and different levels of return. And then equity is at the other, right? Where you're kind of ride or die with the company that you've invested in. There's riskier equity and higher risk equity, lower risk equity. But because of that trade-off, debt is almost always senior in the structure. And that's the trade-off. To say we're going to give up some of our return, we'll let the equity take any of the excess, but there's some amount that we're sort of contractually committed to and that we know we're going to receive. That's the kind of puts the floor on it unless the company collapses or there's some kind of binary event. And then I'll get into sort of what are the flavors of debt and how you can apply them in a climate context. But I'm setting this to set the table, which is when you're thinking about talking to a lender, you have to remember that when you're talking to an equity provider, they have limited downside and unlimited upside, right? Like it's actually a really attractive proposition. You can only lose as much money as you put in, and you can make as much money as your equity can be worth. It can go up 1,000 times. You can only lose 1 times your money. Right? Like you can't lose 1,000 times your money. And so that asymmetry is really attractive for equity investors. Debt investors have the exact opposite situation, right? They have ostensibly the ability to lose everything, but they only have the ability to make 1.1 times, right? So like if you have -1 over here and 0.1 on the other side as your maximum potential return, that is going to lead to some very specific behaviors, right? It just means that you can't, in a portfolio, you can't tolerate maybe 1, but you really can't tolerate many, if any, companies or loans going to zero, not paying out, because you're not making enough on the other side to compensate for it. And so you just have to remember that, like lenders are highly rational. And the reason these things are structured, the reason you have all these covenants, the reason they're doing so much analysis is because their incentives are skewed, right? There's much more downside than there is upside in a loan because you still can lose everything, right? Like there's a chance if the company goes bankrupt, the assets go to zero, you've lost everything and you have no ability to make it up on the other side.
Yeah. And I think that's really important for founders to keep in mind because they have to think like the investor a lot of the time. And so when you're pitching to, let's say, a bank and you're talking to someone that's going to issue you debt, you have to see things from their perspective. So that was really helpful context.
Yeah. With that said, and then there are many different debt becomes like anything else, debt becomes quite specialized. And so given that that's the case, right, that debt has this weird asymmetry, every flavor of debt is sort of built upon a risk management structure that makes sense. At the basic level, you can think about assets, right? And things like equipment. And this is, I think, for many venture-backed companies who are building equipment, who are working with equipment, it's a great place to start because like you have some kind of product. It could be an air conditioner. It could be a battery. It could be a solar panel. It could be a vehicle of some kind, either conventional or exotic. And there are lots and lots of companies that are in the business of lending against some very specific asset, some very specific piece of equipment. And they're saying, look, instead of you guys going out and buying these assets, we'll own the asset. We, the lender, effectively will lend it, we'll own it, and we'll lease it. We'll kind of lease it to you, right? So there are different flavors of either equipment financing or venture leasing is what it's called in some cases. And they make some determination, like in an absolute worst possible situation, this piece of equipment is worth 50 cents from its market value. And I don't really care. I don't have to do too much brain damage on whether I think this company is going to be around or not. I'm lending them, I'm effectively leasing them a pizza oven. And if their pizzeria goes under, I take back the pizza oven and I lease it to someone else, right? Or I can sell it in the secondary market. And it allows lenders to effectively disaggregate the risk of the enterprise or the entity that's doing the leasing, not entirely, but to some extent, from the asset itself. And so I think you'll see that's pretty common. The more esoteric the asset, the more kind of complicated it is, or the more specialized the lender to be. So like we have an amazing company called Near Space Labs that build weather balloons. And these kind of highly customized weather balloons with camera arrays, they're really cool assets. They're hugely valuable to someone who's in the business of launching weather balloons with camera arrays. They're probably not that valuable to someone who's not in that business. So I don't know what the secondary market of that asset is, right? Mm-hmm. And if you're a lender or equipment leaser and you have enough volume in that particular category, maybe you work with all 10, you work with all 50 of the companies that are in the weather balloon and camera space, then maybe you're like, yeah, I can actually get my head around the risk here. That's the kind of like a great kind of early building block, right? And you often see this with early stage companies, small businesses. It's like something concrete that they can underwrite. There's a known kind of secondary market for those assets. The second kind of building block that you see is corporate loans. Now, most venture stage companies, let's call this the traditional venture-backed company, which maybe is either early, doesn't have much revenue, or is certainly not profitable yet. There's only so much corporate lending you can do or corporate borrowing you can do, right? Because a corporate loan looks at the business itself and says, there isn't necessarily an asset I can liquidate at the end of the day. I have to have some reliance that this particular business itself is going to be around at least as long as the term of my loan, preferably longer, to pay me back, right? To pay me back by principal and pay me back interest. And there's millions of small businesses that get small business loans. Some of them are kind of subsidized by the federal government from the SBA, some of them from your local bank. And those loans will have different degrees of covenants, but without, let's call it a big equity cushion. Like, let's say you're an early stage venture company. It should be impossible for you to get a normal business loan, right? Because your business, it's a melting ice cube. Whenever you run out of whatever money you have, like you will no longer have any money. And if you don't have really that many customers or if your contracts are unprofitable, you will have no source of income to pay back the lender. So that's why historically, early stage companies are not able to just go out to a bank and get a normal loan because the bank says, I don't know how long I can predict how long you'll be in business. Now, you do get hard money lenders who look at shorter and shorter increments. So they may say, I don't know how long you're going to be in business, but I can lend to you for, this is called like revenue-based financing. I can lend to you for a week, 2 weeks, or a month, or 2 months, or 3 months. And I'm just looking at like, there's some revenue pattern that I can see. I guess I care that you're going to be in business, but this thing is really quick. It's like a payday loan, right? It's like, I'm going to give you money. You're going to get income from your customer. You're going to pay me right back. I'm going to give you money again. You're going to get money from your customer. Those things get really expensive. That's right. Kind of like a revolver. And they're really expensive because there's a lot of volatility in the underlying company itself. And so it really just has to rely on a very short-term analysis of customer income velocity. But to go back to the corporate piece. So the one flavor of corporate lending that has evolved in the venture space, and the one that probably, to the extent that most people listening are venture-backed companies, is familiar with this venture debt. And this was widely proliferated over the last couple of years. Silicon Valley Bank, Hercules, Horizon, WTI, there's a bunch of other specialists that flooded into the market. There are many more that are now flooding out of the market because it's not the gig that it used to be. But the thing that a lot of, I think, early stage founders don't always fully appreciate is that Silicon Valley Bank is not actually lending money to your business. It may feel like they're lending money to your business, but what they are often doing is they're asking you for a very large deposit. So you just raised $5 million from whatever company or $1 million from whatever lovely venture firm. They're saying, that's wonderful. You have $1 million. Put that $1 million in our bank. We'll take that $1 million as a kind of security deposit, and then we will lend you back a portion of that $1 million. And you can say that you have debt. But really, like, you've given Silicon Valley Bank the money that they're lending back to you. Now, this is for banks who take deposits and the ones that do it. It's a pretty great gig, frankly, because your loan is cash back. That is your underwriting, at least for most of it. You're saying, I have $3 million of cash. I'm going to lend out $1.5 million, and I'm going to try to maintain some ratio of cash, unencumbered cash, to debt that I have outstanding. And so it feels like, and it looks like you've got a nice loan from Silicon Valley Bank, but as your cash dwindles, then SVB's temperature rises and they get more and more nervous and they say, you got to go out and raise some more equity, or we need to start calling back some of our loan. And it didn't happen for a long time because equity raising was so fluid. And once that stopped, you started to see a lot of that behavior, right? Just saying, like, we've got to tighten up these positions or pulling our horns or try to reduce our exposure. And so for a long time, it was a fine source of capital, albeit it's sort of like phantom debt in a way, right? Because it's only debt that is being extended against equity that you have somewhere else. And there's exceptions to that, but usually those are businesses that are already quite large and have really established customers and other sources of demonstrable value. They look more like a corporate loan. The problem, of course, for climate tech companies, and again, in a software business, that can work pretty well because you're sort of in software, the margins are so fat, they're so good that you can afford to spend a lot of money, right? To say, I'm going to just go acquire customers. And these customers are going to be pretty sticky. And the margins in those customer contracts are going to be so high that once I've done it, I've got this really beautiful, juicy, cash-generating asset of these SaaS contracts that are pure, it's basically pure cash flow. And so it's worth it. It's worth it to say, even it's worth it for Silicon Valley Bank and a traditional venture lender to say, yeah, like, we'll lend to you to use towards growth because we know that every new customer you bring on board is effectively generating these longer term pools of this longer term free cash flow that is almost all profit and can go to support future debt service. And so it's a worthwhile bet to make. For climate tech companies, that's often quite different, right? These historically venture-backed businesses, everyone wants to be asset light. In climate, it's an asset intensive industry. Right. I mean, you don't necessarily have to hold those assets on your books, but this is an asset intensive industry. And the margins on those assets are highly constrained. A solar panel is only going to produce so much power, and there's only so much margin that's possible because the cost of making the thing and shipping the thing and installing it and selling to the customer, right? Like, when you layer all those things, there's an intrinsic margin that exists in infrastructure. And at scale, that margin gets really compressed because it's competitive, because these assets are highly sticky. And so I don't know what the long-term, even equity, the long-term equity return on infrastructure assets is, 8%, 9%, something like that. And so you just have to remember that even if in the beginning something seems like it has a high margin, at scale, all kind of climate infrastructure assets sort of regress to that mean, right? They regress to sort of the returns on infrastructure to some extent, right? Because there's lots of investors at scale who want to invest in these types of assets. And so the returns on those assets also kind of regress to that level. You can't take sort of speculative debt to put these assets in place and they say, well, we'll have so much margin from these assets once they're installed, right? Because ultimately, if the required return, really brilliant guy from Homecoming Capital, who's sort of framed it to me this way once, and it always really stuck with me. He's like, you cannot have assets whose ultimate return is 8%, 9%, 10%, 12%. And venture equity, whose required return, or any kind of equity really, but venture equity, whose required return is 30, 40, 50%. You cannot fund one business with a return stream of 10% with an investor base that needs a 30% return and expect that to work out, right? And so these kind of assets ultimately long-term need debt, or they need capital that's priced according to their long-term returns. And so venture debt can be useful, but it ultimately is not predicated on a business model where, like, the margins need to be really, really finely managed, right? And where the pricing of the debt needs to be really, really well matched to the performance of those assets. right? Because in the beginning, it's a weird proxy for cash on hand. So anyway, this is what led us down this journey of saying there's a lot of lenders who, once you get to scale, once you get projects or assets deployed at scale, and I guess this gets to like a third big category of debt. So you have equipment leasing, which think of it as just like it's boiled down to the asset itself. You have corporate leasing, which is you have a business that's pretty predictable. It could be a big business. It could be a small business like a franchise, like a Subway franchise, where you're like, I know exactly what these things generate. You pick the right area. It will generate a certain amount of income. You can pay back a certain amount of debt, right? There's sort of a highly easier framework. There's venture debt, which is basically backed by either current or future equity that's coming in, or contracts if they're profitable enough that once they're in place can support some of that debt. And then once you move past those basic form factors, you then get into the more kind of sophisticated, larger, more mature parts of the debt markets. And certainly for climate tech, some of the most important, right? So project finance being sort of a critical piece of this. So many of these climate technology assets look like projects at some scale. It could be a tiny project. It could be a tiny, even a single device, but sort of some kind of project installation. Related to that are larger and more kind of complex forms of asset-based financing. So where you're now not just looking at a single asset, a single piece of equipment, but maybe you're looking at a more complex array of assets that maybe function together in some kind of a systematic way, or it's a large pool of inventory, right? That you're looking at, a pool of like inventory finance. And there's a more dynamic component to it, right? The inventory is being sold at a certain cadence. You have customer contracts on the one side. You have debt that can be sort of priced and sized based on the amount of inventory you have, either the velocity of those customer contracts or the size of the customer contracts. So you have different flavors of asset-based lending, right? So again, look at some kind of underlying asset beyond just a single piece of equipment, but something that's maybe more complex, like a fleet of vehicles or a fleet of assets, and project finance. Maybe I'll pause there. I mean, there's others, but we've found that like a lot of things in the sort of asset-based world, in the project world, a lot of those frameworks are the most important for climate tech founders to start to understand, even if it's not debt that they're going to utilize day one, but to understand like this is where they might evolve to. And then there's different ways of implementing asset-based finance, and there's different ways of implementing project finance, whether it's on balance sheet or off balance sheet. And I can get into what those mean as well. That's kind of like an initial kind of landscape overview.
I think that's a perfect overview. And I think it's a great way to start because it's all very theoretical, I think, to people to talk about the different asset classes. It would be awesome if you could give us an example from some of your portfolio companies as to what they did to sort of finance their growth. And then I would love to get into like on balance sheet versus off balance sheet.
Yeah, definitely. I'm happy to. And I'll give sort of two or three just from our own portfolio. And then there's plenty more that we see. So I'll start with one called Borrow. Really cool little company in our portfolio. They built a more flexible way of getting EV leases out into the world, short-term leases. So moving away from the traditional 2-year kind of lease timing. And so for them, and this is pretty common, there's a dozen different companies. There's probably 24 or half a dozen, whatever, 50 companies trying to do some version of this, which is how do we make it easier for people to access EVs, right? This is as you're seeing this transition in the overall vehicle fleet. And fleet financing is a highly mature market, right? Both vehicle financing at an individual level, vehicle financing in a group of large, once you get to a large fleet size, highly, highly commoditized. It's very competitive. There's 10 different like specific flavors of fleet financing that people look at for different auto types. Like, is it focused on the rental market? Is it focused on the short-term rental market? Is it focused on the leasing market? Is it something that's called what's a floor plan line, right? Where you're literally lending to auto dealers during the short period of time that they hold the vehicle in their dealership, which is just to say like it's a highly mature, highly competitive space. But when you're starting out, especially if you're doing a new business model, a new time horizon that doesn't map super well to the existing vehicle leasing industry. And if you're just a smaller business, they need something a little more exotic. And so we saw that as a pretty persistent need. There's a bunch of specialty lenders like Mobility Capital and Inspiration Mobility that have actually cropped up to fill some of this need. So sort of folks who are either building new kinds of fleets or want to build new kinds of auto sales channels, or new kinds of more distributed peer-to-peer models like with Turo and others. And the market's just not mature there yet, right? You have kind of a subscale issue, like Hyundai leasing is not going to really figure out how to work with somebody who has a fleet of 5 cars. Even though they're 5 cars, they're good assets. You can track their depreciation, but you often don't have enough scale. So we worked with Borrow in the early days to say, well, let's come up with something that's a little bit of a hybrid structure to say, look, you have a fleet of cars. We will finance those cars. And obviously, we feel good about those assets. Now, we decided to sort of err on the side of we're going to give you a little higher advance against those cars than we might otherwise, but it's also going to be supported by some corporate equity, right? And some other structural support in the beginning. And this is something actually I would really highly advocate, which is I think a lot of times founders think it's like a huge win if they can get the maximum amount of leverage possible against a given asset or against a given project. And there are many reasons. There are many reasons why it's not a good idea.
No, absolutely not.
It just it seems so attractive. You're like, I need so little money. I just need to put 10% down. But you get this very lopsided exposure and it becomes very non-resilient.
That's what creates the distressed debt market when you have over-levered companies that don't have enough cash flows to support all that debt, and then the company goes bankrupt.
That's right. And so I think what happens a lot of times is people won't anchor on. They'll say, hey, I see what this 100-car fleet is getting. They're borrowing at 8%, and they're getting 100 cents on the dollar for this fleet, or they're getting 90 cents on the dollar for that fleet. It's like, yes, because they're at a certain scale. There's both an asset base and there's a cash flow model behind it that's really well defined, and that you have these 2 levels of risk management. When you get down to a company that's much smaller, the probability that you may have to someday reclaim that car gets much higher. And the relative costs of a workout is what's called when you have a loan that goes sideways and you need to restructure it somehow, or up to and including liquidating the company and the assets. And, the smaller the business, you still need to hire the same person or the same team to do the workout activity. And the relative cost of the workout goes up relative to the size of the assets. And so we were able to do this early loan, partly because we had a bunch of excess equity, but we then did a subsequent loan against a larger portfolio. We helped them kind of buy out this kind of funky, frankly, they had a funky portfolio from before that was over-levered. And we say, look, we'll buy this portfolio out, but but we need to right size the leverage so that it's not putting too much stress on your business. But basically, you want to find a lender in the early days. This is sort of selling our own book here, but I think this is true. There are other folks like this who actually understands the needs and the complexities and the vagaries of the stage of business that you're at, right? Because just translating what a large normal course auto loan looks like for a fleet to a 5-unit fleet is going to be very different. It may actually be easier to just say, look, I'd rather just take a corporate loan, or you know what? We're going to only borrow 30% of the cost of these cars, because you know what? Our lender is going to be thrilled. They're going to look like heroes because they have such a low LTV loan, and they'll get to see us in operation. They'll get to see how good we are at executing against our mandate at turning these leases. And guess what? Every time you show, every month, you're saying, look, these cars are 100% leased, right? This new leasing form factor is working. Then the lender will very happily advance you more money. But it's always good to be able to do it in sort of an incremental way. So that's one. And so we worked with them really to design something that we said, look, we're going to start with the fact that you don't really have a well-established kind of fleet yet, and track record performance history around this fleet. But we're going to work with you to basically build it, right? To be able to build a demonstrated kind of documented history of the performance of this fleet and then the performance of the loan alongside it. Another one was a company called Radiator Labs, again, one of our favorite companies. And this is kind of a similar thing where in the beginning, they come up with a somewhat exotic new asset, a smart radiator cover. And it sounds really simple, but they invented this thing. It's not like it's made by Honeywell and you're just buying it off the shelf from Honeywell and these guys are just installing it, right? There's some idiosyncratic criteria to it. There could be performance risks. And so what they wanted was, hey, can you just lend us money against a fleet of these things? We'll just install them. We have a customer, they want to buy them. Can you just give us money? And I'll get to off balance sheet in a second, but in an off balance sheet structure. And we'll just lend against the customer contract. And we're like, in theory, yeah, we would love to do that. But we need to find an intermediate step where we need to be able to validate for ourselves all the things that you've been telling us about how much your customers love it, how well these assets work, that validating the warranty that you've got from your contract manufacturer around these things. And same thing, right? Like, let's build a kind of training wheel structure where we have some extra support from your company. You have a bunch of contracts for just ongoing sales contracts, and we're going to look at those as additional collateral support, right? So in the beginning, like, anything that you have, use it to support this loan. We're not going to try to oversize the loan, but what we're going to do is we're going to go through the exercise, even though we have a bunch of excess cash that you have, money that you've gotten from a grant. Again, accounts receivable, right? Accounts receivable, literally like money that a customer owes you for work that you've done, which is kind of money good, right? Like, that is a highly financeable asset in the universe of, asset-based lending, right? Accounts receivable is another kind of flavor of it. It's just a financial asset. But say we're going to use everything that you guys have as a source of value to help support this loan. But we're going to start building. And again, this is work that we did that's valuable for us and also valuable for the company. And Samia, tell me if this is like, I know we're getting like into excruciating detail here, but hopefully this is interesting or helpful, for people listening.
I think the detail is really important here, because I think that the problem is that when founders come to talk to investors about it and they only hear very high level stuff. So I think it's really important for them to understand how it's structured, how it could be off balance sheet. So grateful for the detail.
Yeah, awesome. And again, I think this is indicative of our thinking, and I'll sort of explain maybe some ways to extrapolate it to a broader universe of lenders and how you think about going into the market. But the bargain we made with the company was, we're going to build you a really beautiful borrowing base, right? Like, we're going to have a 9-sheet Excel tracker, and every project that you guys have, we're going to literally keep tabs on it. Like, we're going to do, and it sounds awful because you're like, that sounds like a lot of reporting, but it's an incredible asset for you as a company, because you now have a performance history, and you have a performance history that someone else is validating and structuring. And it's different from an accounting statement, because an accounting statement misses all this detail around what's actually happening in your business.
Yeah, absolutely.
How quickly do your assets turn? How long does it take for a customer contract to come through, right? Like, how long does it take for these things to get installed? The working capital cycles of a business are really important at a larger scale, like private equity deals and large scale corporate debt. This is sort of all day, every day. But I think a lot of early stage companies are not used to thinking at that level of granularity, or thinking that it's that important, right? Because the usual signal is you're talking to VC investors. They're like, what's the top line? Or at best, what's the top line and what's the margin on it? And I'll come up with that'll be my proxy for how good a business I think
and
this is.
When you're thinking about debt, you have to think about your free cash flow. And a part of that free cash flow is the change in working capital.
That's right. And like, what is the time, like the specifics of that timing, and the timing at the asset level or at the project level is really important. And so the deal we made with Radiator is, we're going to do that for you. Like, we're going to literally create the template. We're going to create the tracking system, and we're going to take your entire pipeline, right, of contracts. Some from, like, we have an LOI, which is basically worthless, but not entirely worthless, but it's largely worthless, down to like an accounts receivable, which is you've delivered the service and someone owes you money. You're just waiting for the check to come in. And there's a whole spectrum of stuff along the way, right? Different levels of, like, is a contract signed? Has the contract, been signed and a deposit put down? Like, and every step in the life, not every asset has that many gradations, right? But I imagine for most of the folks, if you're in climate tech and you're deploying some of these assets, there probably are some number of milestones, right, in the life cycle of deploying that asset or deploying that project or delivering your service to your end customer. And so the trade-off is, we will actually help to build a tracking system. And what we'll do is we'll assign a different advance rate to every one of these components, right? To like every stage within your pipeline. And, it's definitely a bit of a process. I'm not necessarily saying that every startup or every early stage company should sign up for that, or every lender will ask for it. But you can do yourself a pretty big favor and be kind of a hero if you can almost proactively advocate for something like that, right? Because the value of that performance, now you have to execute. So the risk on the other side is you don't execute. And then you have a record that shows, now you don't have to share it, I guess. But so there is a flip side to being, having some amount of scrutiny. But if you're maturing as a company, you want to lean into growth. I think you want to lean into the hard things, right? To sort of saying, I want to professionalize, right? And sort of hold myself to a high standard as a business. But we found that process was really valuable and really instructive. And what we're able to do is, we started with a relatively small advance. Same thing. We're like, look, you've got a whole bunch of customer contracts. You have some cash on hand. In the beginning, our advance rate maybe was like 40%. I don't know, whatever it was, but pretty low. But the more direct experience we have of seeing how these assets perform and seeing how the cash flows, like seeing what that cash flow cycle looks like, the more we can say, okay, great, we're starting to get some more predictability around this. And to the very early comment around risk management, right? Risk management is paramount. When you have an asymmetric downside relative to your upside, risk management is always going to be front and center in your thinking. And you're always trying to figure out, how can I mitigate risk at any level, right? How can I appropriately price risk? And I think there's this is where I would say one of the things that you're looking for when you're talking to a lender is you either want a lender who's going to be like, look, I'm going to give you money. It's going to be pretty cheap. I don't want to do a lot of work, but you just need to make this thing really, just a really low advance rate. And that's fine too, right? Like that's all fine in course of like building a business. And sometimes those relationships can be quite nice in a way. There are not that many frictions. It's quite simple to manage because they're just saying the relative risk that we're taking relative to a fairly large pool of assets is quite easy. You will generally outgrow those, right? Because they're not really, if the lender is not in the business of trying to deeply understand your business, then eventually somebody will, and you'll want to work with them, right? Either because they're specialized or are willing to take more risk or want to earn more return, or they're, entrenched in a given industry or what have you. But there's nothing wrong with working with a lender who has like a very simple framework. And even if they're offering you what seems like a low advance rate, there's nothing wrong with that. And in fact, it's probably preferable because when lender relationships go sideways, we can do a whole thing on workouts. Like it's really unpleasant. It's unpleasant for everybody. And not because lenders are bad people, but just because the lender has a little existential threat on their loan. It's not being made up for somewhere else in their portfolio.
And that is it for the first part of my conversation with Steve. If you found this episode useful, please subscribe so you can get notified when the next one comes out. Thank you for listening, and I hope to catch you at the next one. Bye, everyone.